There's a mathematical relationship between win rate and reward to risk that determines whether a strategy compounds or bleeds. At 1-1, you need 50% accuracy to break even. At 2-1, you need 33%. At 3-1, 25%. At 5-1, 20%. The math is fixed. It doesn't care about conviction or effort or how much research went into the position. It cares about the ratio between what you risk and what you capture when you're right. This is why Paul Tudor Jones, $8 billion net worth, one of the most successful macro traders in history, targets 5.1 on speculative positions. His words, "For every dollar I risk, I aim to make 5. At 5-1, he can be wrong on 80% of his positions and still not lose money. Wrong on 70%, and he's meaningfully profitable. The win rate most investors obsess over becomes almost irrelevant. The investor allocating at 1.51, moderate risk, moderate reward, needs to be right more than 60% of the time just to stay flat. Same markets, same information, opposite math. Nassim Taleb made $500 million betting against the 2008 financial crisis while most sophisticated funds were collapsing. His framework, which he later formalized in Anti-Fragile, is called the barbell strategy. 85 to 90% of capital goes into instruments that essentially cannot lose value. Treasury bills, cash equivalents, the safest positions available. 10 to 15% goes into highly speculative positions where total loss is possible, but where upside is 10x, 50x, 100x, nothing in the middle. His reasoning: someone with 100% in so-called medium risk securities has a risk of total ruin from the miscomputation of risks. The argument isn't philosophical, it's structural. Moderate positions create the illusion of safety while maintaining real exposure to catastrophic loss. You're vulnerable enough to suffer meaningful drawdowns, but not positioned aggressively enough to capture the asymmetric gains that compensate for them. The barbell eliminates this. Safe capital cannot hurt you. It sits untouched until needed. Speculative capital is sized for total loss from the start. When it fails within defined parameters. See Goldman Sachs surveys family offices annually. These are investment vehicles managing capital for families worth $100 million or more, among the most sophisticated allocators on Earth. The 2024 data, 89% invest in venture capital. Venture capital has a 70% plus failure rate. 7 out of 10 investments return 0. The question is obvious. Why would institutions with access to every asset class, every strategy, every piece of proprietary research, put significant capital into something that fails 7 out of 10 times? Because a portfolio of 20 asymmetric bets, where 14 fail completely, 5 return 2x, and 1 returns 50x, still generates extraordinary returns. The failures are contained by position sizing. The single outlier compensates for everything else. This is the opposite of how retail investors think about allocation. Retail optimizes for avoiding losses and systematically avoids the disproportionate wins that actually build wealth. The psychological architecture matters as much as the math. Moderate positioning creates dependency on consistency. Every position needs to work. Every quarter needs to perform. The system requires constant validation because no single win can compensate for a string of losses. That dependency creates pressure. Pressure creates reactive decision-making. Reactive decisions create the losses the strategy was designed to avoid. The barbell breaks this cycle. Safe capital is structurally removed from play. Speculative capital is already sized for 0, not as a psychological exercise, but as an allocation decision made before the position opens. From that architecture, patience becomes possible. Selectivity becomes natural. Mediocre opportunities don't create temptation because the portfolio doesn't need them. The wealth research is consistent across decades and methodologies. Fortunes aren't built by avoiding losses. They're built by ensuring that losses, when they occur, cannot remove you from the game, while positioning for the asymmetric outcomes that compound faster than linear returns can accumulate. The middle feels responsible. Mathematically, it's the most exposed position available, vulnerable enough to bleed, conservative enough to miss what matters. Talk soon.